Stock ETF. A stock ETF is a basket of company shares that tracks an index or an entire sector. One purchase, hundreds of companies, instantly. The most famous example is the S&P 500 ETF. Buy it and you own a piece of Apple, Microsoft, Amazon, Google, all 500 of the largest companies in America in a single trade. Here is the stat that changes how most people think about investing. 92% of professionally managed funds fail to beat the S&P 500 over a 10-year period. A cheap, passive ETF outperforms most fund managers over the long run. Best for investors who want broad market exposure without picking individual stocks.
Bond ETF. A bond ETF holds debt instead of stocks. Governments and companies issue bonds to raise money. You lend them that money and collect interest in return. The ETF packages hundreds of those bonds into one product. The key thing to understand, when stock markets fall, bonds often rise. That is why investors use bond ETFs to balance a portfolio. When one side drops, the other tends to hold. The average bond ETF yields between 3% and 5% annually, lower than stocks over the long run, but with significantly less volatility. Best for conservative investors or anyone looking to reduce overall portfolio risk. Commodity ETF. A commodity ETF lets you invest in physical goods: gold, oil, silver, natural gas, wheat. No storage, no logistics, just exposure to the price. Gold is the most common example. The GLD ETF holds over $50 billion in assets and tracks the price of gold to the cent. What most people miss: gold and the US dollar move in opposite directions. When the dollar weakens, gold typically rises. That relationship has held for decades. Best for investors looking to hedge against inflation or protect wealth during economic uncertainty. REIT ETF. A REIT ETF gives you exposure to real estate without buying property. REITs are companies that own income-generating properties: shopping malls, hospitals, office buildings, data centers. Here is the part most people do not know. REITs are legally required to pay out at least 90% of their taxable income as dividends. That is not optional. It is the law, which makes REIT ETFs one of the most reliable sources of passive income you can hold in a brokerage account. Best for anyone who wants real estate income without a mortgage, a tenant, or a broken boiler to deal with. Crypto ETF. In January 2024, the SEC approved the first spot Bitcoin ETFs in U.S. history. Before that, institutional investors had no regulated way to hold Bitcoin. That changed overnight. Within 12 months, spot Bitcoin ETFs accumulated over $50 billion. Faster than any ETF ever launched in history. What a crypto ETF gives you: Bitcoin exposure through your regular brokerage account. No wallets, no seed phrases, no risk of losing access to your own money. Best for investors who want crypto exposure within a regulated, familiar framework. Index ETF. An index ETF simply tracks a market index. No manager making decisions, no research team. Just follow the index, keep costs low, and let compounding do the work. The cost difference is what makes this extraordinary. The average index ETF charges between 0.03% and 0.20% per year. An actively managed fund typically charges between 1.5% and 2.5%. Over 30 years, on a $100,000 investment, that fee gap alone can mean a difference of over $200,000. Warren Buffett has publicly recommended index ETFs for most non-professional investors, repeatedly, over decades. Best for long-term investors who want maximum returns with minimum cost and zero stress. Active ETF. An active ETF has a fund manager making deliberate buy and sell decisions inside the fund. The goal is to beat the market. The honest reality? Most do not. Over a 10-year period, the majority of active ETFs underperform their benchmark index. That said, this category has grown 40% in recent years. Some managers genuinely add value, especially in niche markets where deep research gives a real edge. Best for investors who believe in a specific manager's strategy and are willing to pay higher fees for potential outperformance. Leveraged ETF. A leveraged ETF multiplies the daily return of whatever it tracks. A 2 times S&P 500 ETF goes up twice as much when the market rises and down twice as much when it falls. There are 2 times and 3 times versions. Here is the critical detail most people find out too late. Due to daily rebalancing, these ETFs decay in volatile markets. If the market drops 10% one day and recovers 10% the next, a 2 times ETF does not break even. It loses ground. The math works against you the longer you hold. Best for experienced traders making short-term directional bets, not for long-term portfolio holdings. Inverse ETF. An inverse ETF goes up when the market goes down. If the S&P 500 drops 5%, a 1 times inverse ETF on that index rises roughly 5%. These are hedging instruments. Portfolio managers use them to protect against short-term downside without selling their actual holdings. They are not investments. They are insurance policies with an expiration date. Best for sophisticated investors with a specific short-term view on market direction. Dividend ETF. A dividend ETF bundles companies with a track record of paying consistent high dividends. Johnson & Johnson, Coca-Cola, Procter & Gamble, Realty Income. The appeal is simple. You collect income without selling shares. Many dividend ETFs pay quarterly. Reinvest those dividends automatically over 20 years, and the compounding effect becomes one of the most powerful forces in personal finance. Best for income-focused investors who want cash flow from their portfolio without touching the principal. Sector ETF. A sector ETF concentrates entirely on one industry: technology, healthcare, clean energy, defense, financials. Instead of owning the whole market, you are making a targeted bet on one segment of it. If you believe AI is going to reshape the economy over the next decade, a technology sector ETF lets you overweight that thesis without picking individual stocks. If you are wrong about the sector, you are fully exposed to that downside. Best for investors with a specific view on which industries will outperform the broader market. International ETF, 1010 to 1050. An international ETF gives you exposure to markets outside the United States. Europe, Asia, Japan, emerging markets like India, Brazil, Vietnam. The U.S. market represents roughly 60% of global stock market capitalization. The other 40% is everywhere else. When American markets struggle, international markets often outperform. Having some international exposure is genuine diversification, not just the illusion of it. Best for investors who want to reduce dependence on the U.S. market and capture growth in other parts of the world.
Now the ranking. Worst to best for the average long-term investor. At the bottom, leveraged and inverse ETFs. Not because they are poorly built, but because they are almost always misused. Most retail investors hold them too long and get destroyed by daily decay. These are tools for professionals making short-term bets. If that is not you, stay away. Above them, active ETFs. Some managers genuinely beat the market, but the majority do not, and they charge you more for the privilege of underperforming. Unless you have a specific reason to trust a specific manager, the data does not support the premium. In the middle, commodity ETFs, REIT ETFs, and sector ETFs. All useful as portfolio complements. None of them should be your foundation. They are tools for fine-tuning exposure or hedging specific risks. Near the top, dividend ETFs. Underrated. Boring in the best possible way. They do not spike. They do not crash spectacularly. They just pay you, quarter after quarter, and compound quietly in the background. And at number one, by a significant margin, The Broad Market Index ETF. Lowest cost, maximum diversification, 0 decisions required after the initial purchase. John Bogle built this concept 50 years ago. The data has backed him up every decade since. That is every ETF explained. Which one do you already hold in your portfolio? Drop it in the comments. If this was useful, hit like and subscribe.